Assalamualaikum and hello there. Today me, Hazima and my partner Huda gonna talk about ratio analysis. So check it out. Ratio analysis is an important technique of financial analysis. Quantity are converted into a ratio for meaningful comparison with past ratio and ratio of other firms in the same or different industry. Ratio analysis also determines strengths and expose strengths or weakness of a firm. Ratio analysis is divided into three parts. First of all is liquidity ratio. Liquidity ratio is the calculation of a company available cash and marketable security against outstanding debts. The ratio also measures the company's ability to pay its short-term debts. First ratio for liquidity ratio is the current ratio, also known as liquidity ratio and working capital ratio. The formula is current asset divided by current liability to show the proportion of current assets of a business in relation to its current liabilities. Second is asset plus quick ratio. Quick ratio equal to cash in hand plus cash at bank plus receivable plus marketable security divided by current liability to show the ratio of cash and other liquid resources of the organization in comparison to its current liabilities.
Third is account receivable turnover equal to net credit sales by average net account receivable to measure how many times a business can turn its account receivable into cash.
Last is inventory turnover equal to cost of goods sold divided by average inventory to measure of how efficiently a company can control its merchandise. Items show that the company efficiently can sell their inventory. The second part of ratio analysis is profitability ratio that indicates positive current and future performance from the company. This ratio is really important for investors to decide whether to invest or not in that company. First part of a profitability ratio is the profit margin equal to net income divided by net sales to measure the trend of net profit margin over the 7 period in comparison to industry benchmarks.
Second is asset turnover. Asset turnover equal to net sales divided average total asset. The ability to generate sales from fixed asset by comparing net sales with average total asset. Third is return on asset. To measure the net income produced by total asset during a period by comparing net income to the average total asset.
Next is return on common stockholder equity equal to preferred dividends divided by average common stockholder equity. It is really important to measure for potential investors because they want to see how efficient a company will use their money to generate net income.
Last is price earning ratio. Price earning ratio equal to market price per share divided earning per share to measure the market value of stock relative to its earning by comparing the market price per share by the earning per share. The last one is payout ratio. Payout ratio equal to cash dividend declared on common stock divided net income to measure the percentage of net income that is distributed to the shareholder in the form of dividend during the year.
The last part of ratio analysis is solvency ratio that measures a company's ability to sustain operation indefinitely by comparing debt level with equity, asset, and earnings. Better solvency indicates a more credit-worthy and financially sound company in the long term. First is debt to asset ratio. Debt to asset ratio equal to total liability divided by total asset. A higher debt to equity ratio indicates that more creditor financing is used than investor financing. The last one is time interest earned. Equal to net income plus interest expense plus income tax expense divided by interest expense. The number of times a company is capable of bearing its interest expense obligation out of the operating profits and during a period. That's all from us. Thanks for watching. Happy holiday, guys!
Created using Powtoon.